Hello, and welcome to this Hot Topic Hotline webinar on monetary policy, interest rates, and utility capital financing. I'm Dr. Mike Sykuta, Executive Director of the Financial Research Institute, or FRI, at the University of Missouri. For over 30 years, FRI has been facilitating and promoting effective and responsible utility regulation by providing a neutral forum for utility regulators, industry leaders, and consumer advocates to engage in education, discussion, and debate on issues facing the electricity, natural gas, water, and wastewater industries. Today, I'm happy to welcome a trio of economic and financial market experts to share their perspectives on where we are and what we're likely to see in the near future in terms of economic growth, U.S. monetary policy, and what that means for the financial market investors and their appetites for investing in public utilities. Utilities across the board are faced with major capital expenditures for updating, replacing, and expanding their infrastructures to meet growing demand. Those expenditures have to be financed, and the cost of financing directly affects the prices consumers ultimately have to pay for their utility services. Having a better insight into what's driving financial markets in the current economic environment is important for all stakeholders in these industries. We're happy to welcome today Dr. Mark Jensen, Vice President and Senior Economist at the Atlanta Federal Reserve Bank, Mr. Richard Traub, Vice President and Fixed Income Analyst with Nippon Life Global Investors Americas, and Mr. Nicholas Campanella, Senior Equity Research Analyst at Barclays Corporate Investment Bank. We're going to start today with Dr. Jensen taking about 15 minutes or so to kind of share with us where the Federal Reserve is and where we are in our monetary supply system and what that means for interest rates and what future interest rates moves are likely to look like from his opinion. And then we'll invite Ricky and Nick to share their perspectives from the Wall Street side of what that translates into from the investor's perspective. So we're going to start with Dr. Jensen. Dr. Mark Jensen is a Vice President and Senior Economist in the Research Department of the Federal Reserve Bank of Atlanta, with responsibility for leading the Financial Research Economics team. In this role, he serves as an advisor to the President of the bank and Research Director on economic matters. He oversees the finance economists and participates in decisions regarding strategic direction of the research department. He's been involved with the Federal Reserve System's comprehensive capital analysis and review annual stress tests. He is, and on the academic side, he's an associate editor of the Journal of Empirical Finance. He's been on faculty at Brigham Young University, Southern Illinois University at Carbondale, and early in his career here at the University of Missouri. So we are glad to welcome Mark back in that sense to join us here from Mizzou. So Mark, we'll turn it over to you.
Inviting me and just to make sure the technical side of things is working. Everything looks good there, Mike?
Yep.
Slides coming up. Yeah, so as Mike said, I actually was at Mizzou. I remember the RFI and I left in 99, bounced around a little bit, and then ended up in the Fed, about 20 years ago. But I thought I'd take today to provide a little bit of insight into an area that gets a lot of focus and a lot of discussion. But when I start asking, when I ask people about balance sheet policy by the Fed, people kind of always have a lot of questions and really not quite sure how we decide what to do there and where to go and how that then plays into monetary policy. So by the end of this, I hope that we have a better understanding about how we can kind of measure and decide how adequate the size of the balance sheet is. And really that's going to come down to, do we have enough Federal reserves, the reserve liability of the Fed in the economy. So a lot of this really requires having a better understanding or at least some knowledge about the history around the Fed's balance sheet. And so this is a plot that shows both the assets and the liabilities, where the assets are on the positive y-axis and the liabilities to the Fed are on the negative y-axis, going back to really about the time that we started quantitative easing for the third time. where it was just coming out of the financial crisis. And you can see that it grew a little bit, and we got to about 5 trillion in terms of the size of the Fed's balance sheet, and that was primarily in mortgage-backed securities and treasuries. And that's, that there's reasons behind that. I'll talk a little bit about it. And the first time we kind of went through that quantitative easing, we then followed up with quantitative tightening, and that started in the latter part of that decade. And we never really got the balance sheet back down to size before we really experienced the impact of COVID and what that ended up doing to, really financial markets. And so if you look in the graph, you'll see this dramatic increase in the size of the Fed's balance sheet that came about in March of 2020. And never seen anything like this before. That's part of the fun of being at the Fed is we deal with things that, I thought it was going to get boring, and COVID definitely was not a boring time for me. And so really you see this dramatic increase in the size of the portfolio going from below, 5 trillion all the way up to about 9 trillion by 2022. And the real reason that we expanded the balance sheet at that period of time was because of market function. In March of 2020, we ran into a situation where the Treasury market was under stress. And since the Treasury is really the deepest, most liquid market out there, it really provides a benchmark for pretty much all credit markets and helps people understand kind of what that risk-free rate would be. And so the Fed entered into buying treasuries at that point in time in the secondary market so that we had market liquidity in the treasury market and that it could start getting back to functioning on its own. And pretty much we were able to do that. It required quite a bit of outlays, but that's kind of what a central bank is there for. Being able to ensure that there's market stability and things like that. And you can see that on the bottom part of this graph, we increased our liabilities by really issuing reserves at that point in time. That it was primarily, we would buy a treasury security or an MBS and then credit that to a bank and its reserves. And you can see in the orange line on the bottom that expanded quite a bit. In addition, we did MBS, and we kind of got through that period of market fragility, and then we entered into kind of what you would think of as being quantitative easing to support monetary policy. So we continue to buy treasuries, we continue to buy MBS, not because of market fragility, but really because the Fed got to the point that our policy rate was close to zero. And instead of going into kind of a negative interest rate environment, it was determined that it made sense to go ahead and start purchasing treasuries, continue purchasing treasuries, so that you could maybe impact medium to long-term rates. By buying treasury securities, we take them out, that pushes the price of those particular securities up, and hence the interest rate on those securities go down. And we felt that was a way that we could have monetary policy effect along the whole yield curve, not just at the short end through really our Fed funds rate. And so we see that kind of occurred. And in response to that, we got some, what people think is accommodative financial market conditions, lower interest rates, probably encouraging people to invest, going out and leveraging up, taking kind of maybe a risk adverse and moving it more in a risk neutral standpoint from an investor context. Now, all that continued to occur in about 2022, and then we started to slowly decrease our balance sheet. Now, QE, quantitative easing, is really the asset side. Everything that's going on with regards to trying to stimulate the economy, bring it out of this COVID recession, things like that, we're on the asset side and expanding, and that's QE, or quantitative easing. When we start to talk about QT, quantitative tightening, in other words, running down our balance sheet, we're really end up starting to talk about liabilities, the other side, on the negative side. And one of the things is that during the time that we were increasing our balance sheet, we found that banks just didn't want to hold any more reserves. And so during that time, we introduced a new facility called the reverse repo facility. And the reason it's a way that money market funds that were receiving that cash or those funds that banks didn't want to hold because they would be penalized through regulatory type of fees, they would then, either issue or give it to the money market fund, and then the money market fund would have to figure out a way to, something to do with it. But we're at a period of time where financial markets were showing, for us, it was a zero interest rate environment. So to be able to kind of allow these money market funds to continue to stay in business and not issue negative returns on their particular product, we ended up creating this reverse repo facility where a money market fund with its current assets under management could take those, give it to the Fed, and then the Fed would issue that particular money fund a treasury that we were holding as collateral. And so it's literally the Fed borrowing from money market funds and paying them a return on that. And that was really to make sure that the interest rates overall were above zero. And you can see how that blue section of the reverse repo grew out quite big. And yeah, the reserves got bigger, but once they got to that steady state, size, really didn't expand anymore. It was really through this reverse repo facility that funded all of these assets that we were buying. And so if I look at that liability side, you'll notice kind of where the reduction in funds in our balance sheet came from. And it's primarily through it's primarily through that reverse repo. And so the reverse repo got very, very big, and then it got very, very small. But notice reserves didn't change. And reserves are this very, safe, liquid asset that banks have to help them with, bank-to-bank payments and things like that. But yet we also think about it as being kind of the lifeblood to the financial markets. And so if you're thinking that shrinking the balance sheet of the Fed would tighten financial conditions like we thought that quantitative easing was, we haven't really seen that because the reserve level stayed so large. And it was really through this reverse repo facility that we were seeing shrinkage. So if I go ahead and get a little bit more detailed on what was actually going on in our liability side, here's a graph on the right-hand side that's really showing you where the reduction in the size of the balance sheet was coming from. And you can see by the blue area that was really coming from reverse repo facility. Money market funds were not lending as much to the Fed, and so it's gotten smaller, or it's got smaller. But in this case, it's gotten more negative because it's off of the original level. One thing you'll notice here is that if you look at the orange part on the right hand, reserves really didn't. You could go out almost to 2024, and reserves had not gone down. So you're thinking of reserves as being kind of the money supply in this context, and it hasn't really gone down, then financial conditions probably haven't really tightened up at all. And you'll see that, it's grew a little bit. And this goes through the beginning of October, and you finally start seeing reserves starting to shrink. And one of the reasons why reserves were so kind of resistant to shrinking, one was because of that reverse repo. The other reason was because of the debt crises. The debt limit crisis created a situation where the Treasury had built up their checking account, and that's this green line or the green area. And so they built up their checking account with the Fed, the Treasury did, and that was maybe right around $800 billion. And then because of the debt ceiling limit coming, the Treasury ran that thing down to close to zero. And you see that in that green line really going through the end of 2022 into 2023. And then once that debt ceiling was raised, you can see how the Treasury then turned around and started replenishing their checking account, this TGA, the Treasury General Account. And that's why you also see it go back up. So when the Treasury goes ahead and starts drawing from that TGA, they are actually adding liquidity into the system. And so during that whole debt limit crisis, they were actually putting more liquidity into the system by spending down their checking account. Well, after this last episode of the debt ceiling crisis, we now have the Treasury doing the opposite now. After the debt ceiling was raised, the Treasury started issuing more securities, and they started to build up their checking account from close to zero all the way back up to $800 billion, where they're basically at now. And during that time, as they built up their checking account, because the reverse repo had gotten so small, it started to come from reserves. And that's why you see reserves starting to fall after you experience this end of the debt ceiling crisis. And so now we're actually at a period of time where reverse repo is essentially zero, and any reduction in the size of the Fed's balance sheet is going to come pretty much directly from reserves. So if you think about quantitative easing as buying assets, increasing reserves, now we're in a period of time where we're shrinking our balance sheet and pulling reserves out of the system. And so you could kind of see that as being a period of time where now going forward, financial conditions are possibly going to be tighter than they have been. And so we are now getting to that point where we can actually start asking ourselves, is there enough reserves in the system? Is there enough liquidity to be able to fund all of the lending, all of the investing, all of the leveraging that occurs? And so one way that we kind of monitor this in determining whether or not there's enough liquidity in the system is by looking at how much liquidity there is, Fed liquidity, relative to the size of the economy. So the black line here, its vertical axis is measured on the right-hand side. And right now, you can see that the total level of liquidity provided by the Fed today, relative to the size of the economy today, is just a little above 10%. Is that too small? Is that too big? Well, it's definitely come down, so it's not too big. So, but how small can it get? Well, the benchmark that we use there is really September of 2019, when the repo markets really failed us. And if you go back and you look over to the left-hand side, you can see at that particular time that the total liquidity in the system, in the financial system, relative to the size of the economy at that particular time was lower than 10%. And you can then look at the secured overnight repo rates, which is that orange line, and what happened there. That all of a sudden you saw that borrowing costs overnight got extremely expensive. You can also see that prior to that, things got really volatile. And so there wasn't enough liquidity in the system at that time, and that's why it was bouncing. That secured overnight funding rate was bouncing all over the place. And so once we saw that September event of 2019, the Fed started to expand its balance sheet again. So using that 2019 episode, really the entire 2019 episode, compare that to today. We don't have the level of volatility in the secured overnight funding rate. We don't have the peakiness that we had back then. And so if I do an eye-to-eye comparison right now, I could say that financial conditions could get tighter, liquidity could get, we could reduce liquidity in the system and still be able to have an overnight market that's still functioning and providing the liquidity for the system that's needed. We're getting close to that point. I think after we went through that debt crisis and going ahead and pushing that forward, you can see how much liquidity has dropped in the last couple of months. And that's because the Treasury was replenishing its checking account. Well, that's probably going to taper off. And so, with the Fed only running off, say $20 billion in its assets every month, it's probably not going to get down to that range that we would be concerned about that we saw in 2019. And so I have a lot of comfort at this point in time that there's still enough liquidity there. But it's now a particular interesting time that we're now seeing this one-to-one reduction in reserves, and hence we need to be a little bit careful about financial conditions and whether or not there's going to be tightening going on there that we haven't seen thus far in the shrinkage of our balance sheet. And so I'll just leave it there, and we can talk some more, during the Q&A if you have any questions.
Thank you very much, Mark. So as I said earlier, we have with us today also Ricky Traub from Nippon Life Global and Nick Campanella from Barclays Corporate and Investment Bank. Ricky is on the fixed asset side, or the fixed income side rather. And if you're not familiar with that term, that means he's basically focusing more on corporate bonds and debt type issuance. Nick is more on the securities or the equity side of the business in terms of what they're doing. So they're kind of going to be able to kind of address both of those sides of the financing option for our utilities. Ricky, why don't you take a few minutes, introduce yourself a little more, and give some thoughts in reaction to what Mark had to share, and then we'll go with Nick.
Sure. Thank you, Mike, and thank you, Mark, for the presentation. As Mike said, I'm on the fixed income side at Nippon Life Global Investors Americas, covering utilities. And just as a disclaimer, my comments today will be my own opinions and not those of Nippon Life. But certainly, great presentation, and it really feeds into the capital needs of the utilities, both this year and then as we go forward into a larger CapEx cycle. I think it's certainly important from the short-term financing standpoint to have that federal liquidity, particularly in the overnight market, as I think about commercial paper. And it seems like the need for commercial paper has really grown over the last couple of years. We've had a lot of volatility in natural gas prices. There's a lot more lumpier CapEx. So just to bridge the gap between some of the longer term financing, important to have a functioning commercial paper market. And I would expect companies to use that in utilities going forward quite a bit. And then on the longer term side, certainly have seen an increase in the long-term debt that's been issued by the utilities. This year, expectations are about $130 billion for investment grade utilities. Last year was about 120, and the previous higher year was 2020, and that's where we had much lower interest rates. So even with a higher interest rate environment, we're still seeing much more utility issuance. So as that continues to grow, as CapEx expectations climb up here, the need to access the debt capital markets throughout the year is going to be very important. They won't be able to issue, just in one particular quarterly earnings or just in one particular busy season. The market's going to have to be fairly stable throughout the course of the year in order to accomplish just the quantity of debt that needs to be issued. And also with the lumpier CapEx, like large, gas plants or larger projects to serve these data centers, the amount of single issuance from particular issuers might be larger as well. So it might be one utility opco company that hasn't issued in the past year that now has to issue much more than they're used to. And it's important to have the access to the capital markets to be able to do that. Otherwise, the timing could be challenging for the utilities to do so. And then also on the security side, there's been a lot more hybrid issuance this year, junior subordinated notes that are getting 50% debt credit, 50% equity credit. And those in particular, refinancing those, it's much more challenging when there's too much tightness, too little liquidity in the market, or financial conditions are pretty challenging. So if those are going to be issued more and more, we need a strong financial backstop or backdrop for that to be able to happen. And then just finally, on the investor side, looking at the debt instruments right now, investors are able to, handle all of the supply that utilities are issuing. All-in yields are pretty attractive relative to the past couple of years. It's about 5% for the utility index if you look across the curve for long-term debt financings. But as we look forward and the trajectory of the interest rates, it'll be interesting to see how that demand changes. If we do go into a lower interest rate environment, perhaps the demand for utility bonds might not be the same as it is currently. So it's going to be a trade-off between the spread for the utility bonds versus the trajectory of the interest rate, combining that into the all-in yield for the utilities. So those are some of the things that we're watching. And it's helpful to have the current liquidity backstop that we have. But if it does get a little bit more tight, then it'll be interesting to see how the utilities adapt. So I'll toss it over to Nick.
Great. Thank you, Richard. Hopefully everyone can hear me. Thanks for all the speakers today and for the opportunity to speak myself. Nick Campanella, I'm the Barclays U.S. Utilities Analyst. I cover these stocks from an equity perspective. So I'm the one putting the buys or the overweights, the underweights, and the equal weights on the stocks and writing the reports. I think one of the biggest things that is lost on equity investors sometimes, and sometimes even industry stakeholders, is that what happens in the debt markets is really going to impact the equities of these utilities because of the capital-intensive nature of their business models, right? And also the need to maintain investment-grade balance sheets to keep funding costs as low as possible. So, typically with higher interest rates, that can pressure cash flow, that can pressure how agencies view proportions of holdco debt to total debt. It can force more equity issuance to our sector, and we value things on PE. So when your EPS is moving lower, you're looking more expensive, and the stock will go down. That also implicitly raises the cost of equity capital for my sector as well. Mark spent some time talking about the impact of SOFR, the dynamics and the size of the Fed's balance sheet. What I can say is that, and this is our view at Barclays, is just SOFR plus or minus 50 basis points. I don't really think that that's going to make a major difference to the utilities on an equities basis. But 150 basis points definitely could, because that is going to make for more challenging financing costs to fund this CapEx outlook. And we're not really expecting authorized ROEs to move dramatically in this current environment, especially with the backdrop of affordability. One thing that I think is really interesting about the sector is you have all of these things kind of happening at once, right? You have higher CapEx budgets, you have lower cash flows from the interest rate increase that we've realized over the last 4 years. And now at the holding company level, we have a lot more equity issuance in the utility sector. So on average, we cover about 38 stocks at Barclays. 34 of them, 34 out of the 38 stocks now have to issue equity. 3 years ago, that number was more like 5 out of the 38 stocks. And utilities on average are issuing about 10% of their total market cap to fund the next 5 years of growth. So it's about 2% dilution a year that investors now have to look at. 3 years ago, it was only 3% of market cap over 5 years. So there's an increased reliance on equity investors to fund utility CapEx going forward, which is a dynamic that has not existed when I started in the sector about 10 years ago. But at the same time, generation investments, low growth, that's materially changing the outlook for rate-based growth. Right now, we see the sector growing rate base at roughly an 8.5% CAGR. It was about 6% 3 years ago. And when we get to the end of this year, a lot of the companies are going to be giving new outlooks at EEI. I would expect that number, that rate-based CAGR number for the sector to grow closer to 9.5%. I would just flag that there are going to be some companies that are going to be issuing probably 25% of their market cap over the next 5 years, and they're going to be growing rate base, at 10 to 15%. And with higher growth does carry higher risk. Access to capital under this environment, I think, is extremely important. I'm not going to sit here and pitch for higher ROEs, but I do think that, lowering ROEs from here on the back of, a 50 basis point or 100 basis point move in SOFR, that can disincentivize capital, that can force companies to pull back in certain jurisdictions and reallocate capital to jurisdictions where they're at least getting an average return. National state average on return on equity right now is 9.6%. The pre-interest rate increases, if I just go back to Mark's chart on slide 4, we've had, call it a 300 to 400 basis point increase in SOFR and in yields, right? We've had about a 20 basis point increase in authorized returns over that same time frame. We've gone from about 9.4 to 9.6. So you've had very little compensation for that on the equity side. And frankly, now the group is being kind of saved by this acceleration in rate-based growth, as well as load growth, which does add cash flows, and then eventually we can pass some of that back to ratepayers to help with the affordability dynamic. But I guess the point of my messaging is regardless of the trajectory of interest rates for the next 6 months to a year, I do think that regulatory decisions are going to determine where investors are going to be allocating capital, because capital needs are going up for the sector, and all in, we want to see regulatory jurisdictions continue to kind of be constructive here. So maybe I'll leave it at that, and we can kind of get into questions.
Okay. And Nick, your audio is getting a little crackly. I don't know if you could check on that as we go around. But so, Mark, if I can come back to you, great explanation of the balance sheet and how that's affecting the liquidity in the market. Many average people out there, we hear about the interest rate discussions, and the Fed's meeting later this month and is going to be making more discussions. And what they're focusing is on the federal funds overnight rate, the SOFR that you've been talking about. But can you provide a little bit more explanation on how what you're talking about in terms of liquidity is affecting the interest rates that utilities are actually paying versus kind of what the average person sees on the media about these interest rates and what the Fed's doing and how that might come into and where that comes into play? Does that make sense?
Yeah. So a lot of this is operational, but it also, I think, feeds down into the actual, markets themselves. I would say that there's a close link between our policy rate and the secured overnight funding rate. They're both overnight. They're both one is uncollateralized, which is the Fed funds market. You're just trading between banks, but the secured overnight funding rate is secured, but it's also very similar. So in the sense that it's overnight, but it goes beyond just banks. Trading in reserves is restricted to depository institutions, and to be able to get the whole growing kind of non-financial sector, non-bank sector into this monetary policy space, we have the repo markets there. And so we keep a close eye between how these secured overnight funding rates are responding to our Fed funds rate. And we get a lot more action, a lot more behavior, a lot more sensitivity in that SOFR rate than we do in the Fed funds rate. And so our Fed funds rate is still our primary target. It's still our policy rate. It's what we have a monopoly on. We're the one that controls reserves. We can, increase and decrease that in a daily basis. Not so clear with regards to the way that the SOFR rate is done. We don't have direct control in there, but we have set up a situation where, or set up facilities, new facilities like the reverse repo facility I was talking about earlier, that puts a, really puts a floor both on that SOFR rate and on that Fed funds rate. And now as we've, kind of shrunk our balance sheet, it's now putting upward pressure. You can just think about this in just supply and demand. If there's more money out there, you're going to have, more pressure on rates to go down. If you have less money out there, you're going to have pressure on rates to go up. And so that occurs for both the Fed funds and for the SOFR rate. And so to be able to cap it, to make sure that as we shrink the balance sheet, that we don't lose the Fed funds rate to outside of our target, we now have what is called a standing, repo facility, where a primary dealer can take their can go there and take a treasury security and borrow against it, so that they will then have the reserves to be able to facilitate and trades, facilitate their payments, make sure that they balance at the end of the day, so that there's less pressure in that overnight funding market. And so that's really how the two rates kind of line up. The question is for us is really, as we look at that new standing repo facility, is it going to behave kind of like our discount window rate? And whether or not, institutions will come and borrow from it when there is, when there's pressure and a shortage of overnight funding. And that's something that we need to keep an eye on. All of that then just rolls over into the rest of the economy. All of that in terms of, monetary policy and the interest rate then flows over. And so it's really kind of this dance between the balance sheet, reserves, and the Fed funds and this secured overnight funding rate that has to all kind of work together now because of this non-bank financial sector getting so large.
Okay. And for those of you watching, if you have questions that you'd like to ask our panelists, on the bottom of your screen, you should see a Q&A icon. If you can click on that, you're welcome to submit questions and answers, and we'll all see those pop up and try to respond to those as best we can. In the meantime, Ricky, you mentioned how the liquidity is kind of at a margin right now where you're paying a lot of attention to which direction it's going to go and what that's going to mean for the fixed income assets. How does that connection work on the fixed income assets in terms of the stuff that Mark's talking about and how it turns into the interest rates that the utilities are actually implicitly having to pay in terms of the debt securities they issue? And to just add on that a little bit, you mentioned this a little bit. Even if rates come down a little bit right now, most of the debt that's being refinanced, if it's being refinanced now, is debt that was much, much lower interest rates 10, 15, 20 years ago. So even if we do see some interest rate reduction now, the overall cost of debt issuance, that's on the books, is that not likely to go up as we're kind of replacing older debt with newer debt?
Sure. So maybe on the first part of the question, it really breaks into the treasury component of the all-in yield and then the spread component. So a lot of what happens at the Fed level, that'll be determining the trajectory of the treasury component, and then the spread component right now is very little when I think about the all-in yield. So if I think about the utility spread index for investment grade bonds, it's about 0.75%. And then if I look at the average treasury between 5-year and 30-year, it's somewhere upwards of maybe 4% for an all-in yield of 4.75 to 5% if you look across the curve. So the driving trajectory of what the utilities are paying right now is the treasuries, and the spread component, or the risk premium that you get for holding a utility bond relative to just a treasury bond, is actually a pretty small component at this point. If there was disruptions in the broader economy or the financial markets, we could see both changes in the treasury rate and the spread rate, which is where you get much higher overall interest rates that utilities will have to pay. I think a good example of the dynamics is back in 2020, NSTAR, as an example, issued in March 2020, right coming out of COVID. The actual treasury part of that was only about 0.7%, but the spread was about 3% or 300 basis points. So their all-in yield was about 4%, versus right now that same bond is yielding the exact same, but the composition of what that interest rate is totally different. Now it's mostly the treasury and a little bit of spread. Back then it was mostly spread and a little bit of treasury. So both components are what we're watching, and where you get the really high interest rates is both when the treasury kind of widens out, and then you also get the spreads widening out as well. And the second part, if you could just repeat that one.
Well, I think you just hit on it with the replacement cost of debt now versus debt that was issued 10, 15, 20 years ago when treasury rates were really low. I don't know what the utility index spread was at that point in terms of how rates compare, but we're hearing a lot about, well, we may be seeing lower interest rates. We may not be, how much are we going to see interest rates go down? But even if they did go down a little bit from where they are now, is it really going to save utilities a whole lot relative to the debt that they're replacing that consumers have been paying for the last 15, 20 years?
Right. Yeah, it certainly depends on, what's causing interest rates to go down. If it was something that caused spreads to blow out at the same time, like uncertainty in the economy, you might not see that all-in yield change that much. And then the composition of the debt maturity profile and the yield profile might not change too much. But certainly the bonds that were issued 5 years ago during COVID, even with higher spreads, those all-in yields are much lower, and you'll see some pretty low coupons for things issued in like 2021. So whenever they're refinancing like a 5-year bond out in the market, definitely we'll see companies less hesitant, or a little bit more hesitant to issue, like replace that with a 30-year and lock in a much higher interest rate. So maybe at this level, we see a little bit of shorter term debt issuance. And if we do get a lower interest rate environment, we might start to see more 30-year, 10 to 30-year issuance, and kind of rebuild that maturity profile.
Okay. Nick, the shareholders are the ones, when we talk finance, the shareholders are the residual claimants. They get whatever's left over at the end of the day. And ultimately, in some sense, they bear the greater financial risk. So, as this interest rate stuff is changing on the fixed asset side or fixed income side, how is that affecting the risk profile for the shareholders? And we've had a lot of changes in energy policy in the last 12 months, and we expect to see perhaps more changes in energy policy, as well as these exploding load growth, especially in the electricity market. How does that affect the riskiness of these equity instruments for shareholders and the return on equity that they're expecting to get associated with that uncertainty? Need to, your microphone's up.
How about now? How's this? Is this better?
Yeah.
Okay. So, I guess just in the first one, in terms of like, how do the sliding of interest rates change, how people are viewing the multiples or the riskiness of the equities? It kind of turns into a balance sheet trade as well as a refi trade, in that, those that have lower quality balance sheets, I'm thinking sub 15% FFO to debt, or are, along the lines of investment grade, or even in certain cases high yield, can underperform in a period of time where interest rates expand or widen. And then, vice versa, right? I think we've seen at times where people want to own, in high interest rate environments, where people want to own essentially A-rated balance sheets with very limited holdco to total debt issuance. So, some of the stocks that we've seen trade well in those environments would be like an Atmos ATO or a Con Ed, ticker ED. When you kind of think about the riskiness of the equity instruments for shareholders and the return on equity for what is in front of them today, financing all this growth and this load growth that's coming, along with the higher capital investment opportunities, which also drives rate-based growth. You know, what we see right now is investors are being a little bit more, viewing the sector a little bit more rosy and giving credit to the multiples for that growth, which is inherently lowering cost of equity, right? So, we do have stocks that, when you look at them on an asset-based growth forecast level, those that are doing the 10 to 14% rate-based CAGRs, in certain instances are trading at some of the higher multiples and have some of the lowest implied cost of capital, which is actually making it easier for them to go out there and issue equity, which in turn is less dilutive. And, versus if I issue equity at a 20 times multiple versus a 15 times multiple, my EPS solution is going to be a lot different, right? So it's kind of feeding on itself in a positive way. But the problem is as soon as you turn off the spigot to the access to that capital, or if anything happens to that multiple where it decreases in a meaningful manner, maybe it's an out of left field regulatory decision, maybe it's a customer that is pulling out of the jurisdiction, because we all know that data centers are shopping in multiple states, and this opportunity set is not totally clearly defined on which states are actually going to be the winners in getting all this load, as well as the companies behind them. That can change the plan very quickly, and that can change the stock price very quickly. I will point to some more idiosyncratic situations like California with the wildfires that have, essentially, not only raised the cost of debt, but the cost of equity for those companies to a point in which, we don't really think standalone equities in the state, EIX or PCG, have the ability to go out there and really do an equity capital raise. Their growth rates would not be intact if they were to do that. And, that's why you're seeing them try to come up with, more out of the box ideas and how to fund their growth. PCG in the past has sold assets. They are leaning a little bit more heavily on holdco debt, which, the debt holders don't like to see, but it really is a requirement for them to hit the EPS growth metrics that they're, telling the investor base that they're going to hit. So it's kind of like a double-edged sword in the equity world, right? Growth can be good, and the expectation for growth can be good for your multiple and actually help you trade at a more reasonable cost of capital. But it can be an elevator on the way down too, if regulators aren't backing you in a constructive manner, or if if interest rates really get out of control. So maybe I'll leave it there.
Okay, thank you. So shifting gears a little bit, but I think I'll circle back into the conversation. You look at the front page of the Wall Street Journal today, yesterday, and we see really mixed messages about what's going on in the economy, right? The stock market seems to be booming. There's some evidence that the anticipation and based on retail sales and whatnot suggests that the economy is chugging along just fine. At the same time, the data we have seems to suggest the labor market's stagnating, that the inflation rate is starting to tick up slowly again, which are negative signals generally. What do we make of these mixed signals, and where that might lead the economy as a whole, the financial markets as a whole? Kind of what's going on with this crazy mess that the stock market's going up gangbusters and doing super? Interest rates are behaving in a way that are fairly helpful, but at the same time, we're seeing these shadows of potential problems in the labor market and inflation rates. I'll start with Mark, if you can offer some comments and then kind of get everybody's opinion on that.
Yeah, so I came to the Fed 20 years ago, and thought I'd be here 5-6 years because it would get boring. You get in a situation where you raise rates a little here and you cut rates a little there, and pretty much vanilla. And having gone through a financial crisis and going through COVID, the economic conditions in those particular events clearly guide you and direct you to knowing what monetary policy's response should be. So it's not, it's it's one direction. It's just a question of how much. And today's current economic and financial environment is such that it's been the hardest that I've experienced since I've been here, trying to disentangle the balance of risk between inflation and employment. Hasn't been something that we've had to concern ourselves with, and with inflation, it makes things a little bit more difficult. But going back to your question about where I see things or what have I fared. So we actually have a number of branches within the 6th district, and each of those branches has a board of directors, and the branch manager goes out and canvasses pretty much their area. So like Miami and Jacksonville, New Orleans, Birmingham, Nashville. So pretty hot markets. So you get a pretty good view of kind of what a good economy would look like. And I would say during the last cycle between July and September, the color and the narrative that I heard from business people in those branches over that period of time went from I'm really concerned about inflation to there's a dramatic drop in demand. We are seeing just be it hospitality and leisure or be it auto, it runs the whole entire space. And so for someone who's kind of thought, well, our job is inflation, all of a sudden I'm stuck and I'm on my back heels thinking, okay, now I have all these people that said inflation was their biggest concern that now come back and say, yeah, we're really worried about the real side of the economy. So that makes our job hard, because how do you kind of balance these two risks? And I think now we've gotten to a point for myself, and I'm speaking for myself, is that we're really balanced in our approach to this problem. And a lot of this is, we know where inflation is. We kind of have expectations around what inflation could be doing. But this whole weakness in the demand side is brand new. And so we're really trying to still get on top of that and, be able to make a more informed decision around those, about monetary policy with that new information coming in.
So how does that message translate into what we're seeing on Wall Street, Ricky and Nick?
Sure, maybe just starting on the debt side, it's a really interesting dynamic in which the demand driver is pretty separate from what's going on in majority of the country. We have these very strong balance sheet hyperscalers building out sort of at interest rate agnostic levels, whether they went higher or lower. It's a bit of an arms race to develop the AI, and I think it could lead to some important conversations if we do see electricity prices rising on the back of increased demand, but perhaps we do see the economy as a whole lagging a little bit, maybe puts more scrutiny on some of the contracts between the data centers to make sure that residential customers aren't being hurt. And I think that'll be a challenging dynamic to navigate through as we do see where the economy goes from here. But in terms of whether the level of capital expenditures will slow down if there is an uptick in inflation, it doesn't appear so at this point, just given different demand drivers this time around. But I think we'll be watching things like bad debt expense and overall health of the customer that ultimately will be paying for much of it, unless it's separated out by the hyperscalers. So watching that dynamic pretty closely.
Okay, Nick?
Yeah, I'll just say that it's, given that I mainly just live inside of 38 companies on a day-to-day basis, it's harder for me to opine on like the broad market S&P, as well as like the overall economy. But what I could say is that, if there's signs of weakening economy, weakening labor market, I do think that one of the biggest kind of risks that I monitor is affordability. And I do, and sometimes worry about what, Ricky brought up, is this kind of interest rate agnostic approach to deploying capital for some of these large, load growth projects. I do get concerned at some point that, we will hit a wall, and that can, unwind my sector, which has been a part of this bull market trade. It is a top performing GIC sector this year, in the S&P 500, and that can cause a negative impact to some of my names, especially the ones that maybe are already kind of expected to be doing very high rate-based growth offerings. At the same time, I think one of the tricky parts about being a utility, being exposed to utilities is, they're not high growth stocks at the end of the day. When I talk about growth accelerating in this sector, I'm talking about EPS growth going from 5 to 7% to 6 to 8%, so about 100 basis points change. Some companies are able to push that up towards 9, but that pales in comparison to some of the free cash flow revisions and earnings revisions that we see in the tech sector, which is essentially 30% of the S&P 500, right? So at its core, this market acts defensive. When interest rates went up 300 to 400 basis points in 2022, the S&P 500 was obviously down that year. Utilities were the second best performing GIC sector. And then in 2023, it was really the time to prove out their defensiveness, which they did not, because we essentially had to stare at the face of a lot of interest rate revisions to the EPS. So I think that there is actually a window in which the sector still trades against the broad market at roughly a 15% discount in forward PE. That's more than one standard deviation outside of where it's traded historically the past 10 years. And you could see a situation where utility multiples remain flat if the broad market unwinds. You could also see a situation where they contracted the broad market, but just not as much, and kind of outperform the S&P over the next year if we do have kind of any flip into a recession or have any kind of further negative economic data. I think generally our clients in the investor conversations that I've had, since we've gone through the start of tariffs in April, a lot of people are surprised that the S&P is back at this level. But I'm no expert on where that is heading from here. So maybe I'll stop there. But there was another kind of question that came in on the regulatory decisions that I see. Would you like me to address that really quickly?
Yes, please.
Yeah, great. So someone just asked, what would the size have with the unexpected regulatory decision to have a tangible impact on the view of a particular utility stock? Or what would the size of that unexpected regulatory decision be measured in relation to? I think a couple of examples of what I can give you is, we've seen in certain states, a settlement gets put forward in front of the commission that's all party, and then the commission will come in and tweak the settlement. But specifically tweak things like the ROE, which usually creates a negative investor bias. Some of the more kind of obtuse situations that we've seen in the sector, I would point to would be Illinois, where we saw a high 8% ROE given in December of 2024 on that outlook for both the ComEd rate cases, but the Ameren rate cases as well. And that caused, what is still a permanent discount in some of those stocks, and people continuing to kind of question, the overall constructiveness of that state. So I don't think that anyone is losing sleep on going from a 9.9 to a 9.8, because 9.8 is still very clearly above the state average. But it's really kind of when you slip below that state average is when you can see increased scrutiny from investors.
Okay, thank you. So we're pretty much at time. Any last comments as we wrap up today?
Kind of circling back to your question. So, comparing the S&P 500 one of the things is we try to not get distracted by just looking at the overall market. But when we look at sectors, boy, they tell us a lot. I mean, whether or not it's the utility sector as opposed to, so to me, the markets aren't all that deceiving. You just have to know which sector you're in, and honestly, the AI is dominating, and so that's driven a lot of things. But from my standpoint, that's how we've dealt with it, and they pretty well mapped what we're seeing, both in terms of hiring, both in terms of growth, everything. The sectors seem to bear out what we've heard anecdotally.
Okay, great. Thank you, Mark. Nick, Ricky, any last comments? We did have one more comment pop up in the Q&A, how gas utilities betas and volatility trended after the Fed began QT in 2022. I don't know, Nick, if you can address that quickly.
Unfortunately, I don't have the answer off the top of my head, but I'm happy to kind of send that to Michael, who can pass it along to the participant.
Okay, fantastic. Thank you so much. I want to thank you all for taking your time. We really appreciate you sharing your expertise and your knowledge with us today. And for all of those who joined us online, we certainly thank you for joining us, and hope you enjoyed today's seminar. Just know that you'll get a brief survey after the seminar asking how it went and seeking other ideas for future Hot Topic Hotlines. I would be remiss if I didn't share about FRI's other upcoming programs in 2026, our advanced seminar in March on transformational rate design and pricing, our Regulated Utilities Leadership Institute in June, and our 35th annual Public Utilities Symposium next fall. You can check out our website, fri.missouri.edu, or follow our social media account on X if you like more information about those. And again, thank you all for your time, for joining us today, and hope you enjoy the rest of your day. Thanks so much.
Thank you for having us.
Thanks, Mike.